Excellent. Well, good morning, everyone. My name is Shannon Lamont, as Amy mentioned, and I'm the partner in charge of our International Tax Services group here at Eide Bailey. Today, we're going to talk about nonprofit considerations for going global. And of course, this may seem a little bit like a stretch in these interesting times, but I think that it also may require, or it may be really a catalyst to going global. So I hope that you are all doing well, and we are going to talk through these considerations. We'll talk about just considerations in general, sort of the non-tax side of things for a bit, and then also the tax considerations. And of course, I focus in the tax area, international tax area, and I support our not-for-profit group in the work that they do as well, and also often get questions about the various topics that we will cover today. Of course, if there are any topics that I do not cover, I would love to get your feedback and see what else we should be covering in this presentation. So please do let me know in the comments or ask your questions as we go along. And then we'll also talk about compliance considerations, especially given the very hefty penalties that can come along with those. So we'll cover those as well. So I always like to start with thinking about, well, if your not-for-profit is engaging in international activities, what type of activities will there be? The reason is that the tax considerations really are dependent upon what you are doing, and so the different types of activities that we see are items such as hosting seminars or providing operational support for other NGOs outside of the US, making grants as well, and also licensing. So all of those can have some type of international implications. In addition, we've seen NGOs that need education, for instance, and so it requires that they set up an entity in a foreign jurisdiction, and that can create some major complications and considerations both on the US side and the foreign side. And so we oftentimes will get involved with helping with the considerations there as well. Some considerations really on the non-tax side that I wanted to talk through. First of all, we've talked about what products or services you might be considering moving offshore or using offshore. And so, but there are a lot of other things that need to be considered. So there'll be a lot of balls in the air. So what we often find is that it's really important to consider who is going to be involved. So the people side of things. What I find is that companies and non-for-profits are most successful when they have a key point person that is responsible for the expansion or that activity outside of the US. Somebody that's going to be involved from start to finish and getting everything set up, managing all of the various other service providers that you might need, such as attorneys, accountants, etc. Also, location, that's usually driven by whatever cause or whatever activity you are needing. You may, oftentimes, it is a demand from a certain jurisdiction, and so you would look at that location. Or it could be thinking about if you are expanding globally, what would make sense in terms of where you can find talent, etc. As you move to another country, you also need to make sure that you're covering the regulatory framework around your product or service that is moving to another country. So making sure that things like licensing is done correctly, that you've set up in the most appropriate manner for your organization. And also, you'll need to want to make sure that you have a good financial system to keep track of the activities of your organization outside of the US. both for local purposes. So if you end up having some sort of filing requirements in another location, but also for the US to properly report that on your 990. And I always like to caveat here that really it's super important that you have legal counsel involved both in the US and in the local country. We've seen some people stumble in thinking that the US attorneys can cover most of what they might need or what they need to be thinking about in the local country. And that is not the case. Of course, every country's laws are different, and so it's really important to get good local country advice as well. So thinking about grant making, private foundations may either exercise the expenditure responsibility or obtain an equivalency determination when making grants to foreign NGOs. And so I like to point out that public charities also are not subject to the same requirements, but their boards have a responsibility for exercising reasonable care in making grants. So in part to ensure that the grants are not diverted from their charitable purpose. So accordingly, many lawyers representing public charities also advise that they follow the private foundation rules. So I just wanted to point this out for those of you that are just looking at grant making outside of the US to make sure that you're involving the appropriate attorneys to make sure that you're covering your duty of care with respect to grant making. All right, so next I would like to talk through some of the tax risks and considerations for expanding outside of the US for NGOs or not-for-profits. So I, even for-profit and not-for-profit clients, I like to bring up this triangle. It really just solidifies the three prongs of considerations for moving into another country. The first one being indirect tax. So in the US, we have sales and use tax, and outside of the US, we have VAT or value added tax, and sometimes GST, which is goods and services tax. Both of those are very similar in their administration. Also individual tax. So you have people likely that are going to another country or spending time in another country, maybe to serve or maybe to provide administration, et cetera. And so you need to be thinking about their considerations and how that would impact them. And that also ties into corporate tax. So, you know, typically not-for-profits aren't going to pay corporate income tax unless they have some unrelated business income. But unfortunately, the not-for-profit status doesn't extend to if the not-for-profit or the company takes on an activity in another country and they do not have that same status there. So the two that are gonna almost always need to be considered are the indirect and the individual tax, and of course we need to be careful about corporate income tax and whether we can avoid it in some way or by planning it correctly or having the right activities, or whether we can potentially even get not-for-profit status in another country. So the first usual step for a company to expand their activity into another country is to send people. And so I always like to think about, okay, that's usually the first step, and what type of exposure could that reveal? So when organizations are sending employees, we need to be thinking about whether the employer has to withhold on or foreign income tax and report foreign income for the employee. Also, whether the employee has to file a foreign income tax return and pay foreign tax. Also, whether the organization has to register for business in a foreign country, and usually if you have employees in another jurisdiction, you do. And then also whether they need to comply with foreign tax filings. And one of the things that I always want to be cautious about is creating a taxable presence, that corporate income tax piece, and sending employees overseas is one of the key ways that that happens. And so we need to be very mindful of that. So we'll cover corporate income tax first. All right, so the first step is determining whether your activity will cause a taxable presence in another country. This varies by country and whether we have a treaty with that country. So oftentimes not-for-profits are doing business or carrying on their activities in countries that we don't have a treaty with, because that's really a lot of times where the needs are. So the standard threshold to use for that is called a permanent establishment. It's a term that is defined by income tax treaties, but also applies without one. And a lot of countries adopt this in their local law, so that's a good term to become familiar with. Really, a permanent establishment is a fixed place of business through which the business is carried on. And the standard of PE seems to be changing a bit. And there's a desire, because there is a desire to tax based on where the consumer is, or because the economy has also gone digital, they're trying to attract revenue and tax revenue based upon that, rather than having that fixed place. So most of the US treaties will say that in order to create a permanent establishment, or we call it PE for short, you have to have that fixed place of business. So you have to have, some type of office. It depends. It could be that a home office would create a PE. It's not typical, but it could, just depending on the country. But keep in mind that this is changing very rapidly. So it could be that in a few years, other things could create a PE, such as, they're calling it sort of that economic nexus, which is a term that's been used a lot for sales and use tax purposes. But they're looking at that from an OECD perspective. They're looking at whether it makes sense to have economic nexus for a permanent establishment or taxable presence for corporate income tax purposes as well. So in order to make that determination, it's helpful to envision for your organization what activities will happen outside of the US in the short term, but also having a view on the long term. So it could be that you're providing those services, or you're providing materials, for instance, and whether you think that's going to be a long-term or short-term plays into how we want to think about the setup for corporate income tax purposes. So we talked a bit about the tax treaty application in this concept of PE, or permanent establishment. I also wanted to point out that there are certain countries, such as Canada, that also have a services PE concept, meaning if you were to generate a certain amount of revenue from services in the country, that could create a fixed place of business or create a PE. Also, one of the things to consider in terms of PE, and what can create a PE, is if you have employees in a country that have the authority to and regularly enter into contracts on your behalf. So we need to be careful, even if there isn't a fixed physical location. If you have that, they can create what we call an agency relationship or a permanent establishment. So that even if it's they don't have an office, they're maybe working from home, but if they're concluding contracts on your behalf and representing you in that country, that could create a taxable presence risk as well. Also, I wanted to mention that there are other agreements to consider when you're entering into a new country. In addition to tax treaties, there are also agreements that can talk to whether an activity for governmental purposes, for instance, or educational purposes could create a taxable presence, or doesn't create taxable presence for sure. So some of those agreements that you'll want to check into are technical cooperation agreements. There's one with India, for instance, that says certain employees working for government are not taxable. Strategic objective grant agreements, also memoranda of understanding, and there's also some NGO bilaterals. So those are the types of agreements that you would want to do some digging into. Oftentimes if you're working with an attorney, they can help manage whether any of these would apply for you as well. Some organizations have developed a wonderful concept here in the US. Maybe it's an educational platform, etc., and they are looking to license it. So we want to be, even though you're not maybe physically going to have people or locations, we want to be mindful of whether a licensing agreement could create taxable presence as well. Oftentimes, those license fees that an organization would pay to you to use your platform are subject to withholding tax. And that withholding tax can be as much as 30%, for instance, unless there might be a tax treaty to reduce it. So it's something that you would want to think about. If you're going to be licensing your platform, your services to another country, and they're making payments to you, that could be subject to withholding tax. And I say licensing, but also this could apply to services. So in many South American countries, for instance, if a resident organization is paying a service fee to a non-resident, then there's a withholding tax, and it's sort of their way of taxing that income, even though you don't have a presence there. And we don't have treaties with hardly any South American countries, so that's something to be mindful of when you're putting together those agreements, to check to make sure, to see whether the withholding tax might apply. And if you're not paying tax in the US, of course, that could mean that that is a cost to the organization. And that brings us to our next polling question. What type of activity do you foresee your organization engaging in, if you are or planning on going internationally? All right, so next I wanted to talk about the other side of the triangle, one other side of the triangle, which is indirect tax. And I'm going to use the example of VAT because it's what most of the countries outside of the US have. There, Canada and Australia and New Zealand have a GST. So I'll use VAT as my example, but just note that a lot of these rules are similar for GST, very similar for GST. But of course, they all do vary by country. So VAT is similar to sales and use tax, except in its administration. So sales and use tax in the US, you generally think about that being applied only at the end consumer. So if you are a business and you are doing a business-to-business transaction, generally you would not be required to collect sales and use tax on that transaction because you could get a resale exemption certificate. The VAT is different in that it is collected all along the supply chain. So let's say you are purchasing materials from a vendor, and then you are selling them to another organization outside of the US. If the first transaction was also outside of the US. In that case, then it would be likely that you would have to pay the VAT to the supplier, and then you would have to charge VAT to the customer. So that is different than the US, and oftentimes that this is the part that trips people up. Keep in mind also that one difference is that sales and use tax generally isn't applicable to services, but VAT is. So you'll pay it on all the services and digital products that you encounter outside of the US. So I'm going to just walk you through an example, and this is an example really from a corporate perspective or a profit organization perspective, but it also applies for not-for-profit. So one of the questions we get often are, well, we're selling to an NGO or we're providing this service to an NGO, wouldn't that be exempt because they're government? And that's pretty typical for sales and use tax, but not the case for VAT. So keep in mind that that consumer there could be, another NGO in outside of the US. So this is how it would work. We would have a supplier provides goods to a manufacturer. And in this case, maybe it's brochures or something else that your organization needs to fulfill its mission. And they would, as the supplier provides those supplies to the manufacturer, they would add onto their invoice. Let's say the VAT rate is 20%, $200. Then what happens is that supplier then invoices the 1,200 and remits 200 of it back to the government. And then the same thing happens where the manufacturer has paid the $200 of VAT. So they have already paid it to the supplier. They then sell their goods to a retailer. They charge VAT, again, 20% on the value of the goods at that point. So it's increased. They've added $500 of value to that good. Then they have to put on their invoice then the $300. So the net of those two, the $300 that they have collected from the retailer, and the difference between that and what they have already paid to the supplier gets remitted to the government. So this goes on until we get to the end consumer. So what would happen is at the end of the day, what gets collected ultimately and paid back to the government throughout this whole process is the full 20% on the value of the goods that ends up in the consumer's hands. So then the next question that we ask ourselves is, when will that indirect tax apply? So keep in mind that it does apply to charities. The treaties are not applicable to VAT. So remember, we talked about you would be required or potentially subject to corporate income tax if you had a permanent establishment or you had a physical presence. Those treaties are not applicable to indirect tax, so the GST and the VAT. Also, NGO goods and services may be 0 or reduced rated. So these rules are very specific to the country and to the goods and services. So just some examples of 0 rated goods, meaning you still have to register for and administer the VAT, but you would place a 0 rate on these items. Those are things such as medical supplies and equipment, goods and aids for disabled people, rescue equipment and vehicles such as ambulances and lifeboats, scientific equipment, advertising, and construction and building work. But keep in mind that these are just some examples, and it's always best practice to upfront find out whether your goods or services are going to be subject to VAT, how they would be rated. And then keep in mind that even though you may not have created a corporate income tax responsibility in another country, the obligation to register and administer VAT happens generally way before corporate income tax. So each country, unfortunately, has its own rules. There are some very specific rules related to the EU, and we could do a whole presentation on that. It's quite complicated, but just know that if you're going into a new country, one of the first things that you will encounter is this indirect tax or VAT, and you may be obligated to register, collect, and remit the VAT, even though you don't have a taxable presence there for corporate income tax purposes. So next we'll talk through some of the individual tax considerations. And I find that this is usually, well, VAT is probably the most prominent, but this is the second most prominent issue that we need to think about for the organizations. As I mentioned before, if you're sending individuals to another jurisdiction for, it could be meeting with customers or other organizations, Some countries, it's, a very small threshold. You could have an obligation to withhold, just like you would if your employee was here in the US, and report their foreign income. So that's usually the hardest part about thinking, well, do I need a separate entity or organization there in that country? Oftentimes, this is the consideration that drives that, because the organization is going to have to register for income tax withholding for employees and then withhold. And if that happens, likely that's also going to come in, bring into play the employee's obligation to file a foreign income tax return and pay foreign income tax. One thing that is very helpful is if you are doing business in your a jurisdiction where there is a tax treaty. This can be helpful because, in general, if you go into a country where we have a tax treaty, an individual would not be subject to income tax. You would not be required to register, withhold, administer employee taxes if the employee is not there for a specified number of days. And usually it's 183, but not every, but most treaties have little nuances about how they count those days, or whether it's 183 or 180. So you would want to have some sort of mechanism to track the days for an individual. And in times like these where things are uncertain, you might not be able to get out within 183 days. That can cause some issues as well. In order to qualify for this treaty provision, however, the employer must not have a taxable presence in the country, which bears the cost of the services. So let's say that you need to set up an entity for some reason, and that cost is then charged back to the entity in the foreign jurisdiction, then this 183-day rule does not apply. So you need to be careful about whether that is the case, and that could cause this application to not apply. One problem with this is that the employee then could have an obligation because maybe there was a misunderstanding about whether there was going to be a cross charge, and that can be an unpleasant surprise for the employee as well. With individuals in organizations in your sector, oftentimes we run into issues related to those short-term business travelers. So as I mentioned, the 183-day rule is there, but many countries that you're probably going to be working in don't have treaties with the US. And so you need to be cognizant about where they are traveling and how you would determine where they're traveling. So what tracking mechanisms do you have in place? Oftentimes organizations are using expense reports, travel agent reports, and also if it's a very high volume number of people that are traveling, it's probably best to get them into a calendar tracking system. There are apps for that, so if that's something that is applicable to you, we can talk about what apps might be available for you. Next, I wanted to talk about something that's more on the long-term side of things, which is global mobility. So keep in mind that if you do have employees that are going to be staying in another country for a longer term, so they're going to create a taxable presence for themselves, then there's a whole host of things that we like to talk through, make sure that there's a policy in place, for instance. So it's really at the base of it, starting to develop a company policy of the types of things that the company needs to consider for each assignment. And oftentimes, one of the things that companies will do, organizations will do, is enter into a secondment agreement. That is going to provide the details of what the individual's role is, how they will get paid, whether they will be equalized, which I'll talk about, and what the employer will provide, such as housing, car, etc., while on assignment. A secondment agreement is really a transfer of the employee to another organization and the agreement between the two organizations. You also likely have an agreement with the employee as well. So the company can decide to equalize. What does that mean? Usually what happens is if you send an employee to another country, they're likely going to have more of a tax obligation than they would if they stayed in the US. Why? Because in general, the US individual tax rates are lower than they would be in a foreign country. It could be that there's no tax in the foreign country, so that wouldn't be applicable. But what you are doing with the tax equalization policy is really helping the employee to be put in the same position that they would have been had they not taken the assignment tax-wise. So at the end of the day, what happens is we do a tax return showing what it would have been if they hadn't left and what their tax is since they did take the assignment. And the company then will make the employee whole for the additional taxes that are paid. Now, why else would the taxes be higher? Because there are certain things that are included in taxable income in the US and perhaps in the other country, such as housing, car, and things of that nature. So that could also cause a discrepancy in the taxation. So the company makes the individual whole, and then they, aren't adding an additional taxation burden to themselves by taking on the assignment. Also, we need to think about the company's management of the payroll and withholding. We need to decide where the individual will be paid from, either the home or the host country. So sometimes it is necessary to keep the individual, even though they're being paid out of another jurisdiction's payroll, it might be important to keep them on US payroll and do something that we call a shadow payroll, where we're essentially acting as if they're being paid from the US company and paying in the proper taxes, etc. And that makes sense in a number of different circumstances, which we could also do a whole session on just the global mobility aspects here. So, and then generally when companies put employees on assignment, they take over the obligation of helping to get the tax returns filed. Why? Not that they want to get into the individual's business and know all of those things, but it minimizes risk. It minimizes risk for the individual and also for the company, that they don't get in trouble and have to be, something has to happen with them in the local jurisdiction. So generally what happens is the company engages a firm. We provide this service as well, where we would engage with a local firm to provide the wherever they're living tax return, and then we would also file the U.S. tax return, taking into consideration any exemptions and foreign tax credits that might be applicable. All right, so next we're going to talk through the compliance aspects of international activities. And I'll start with some of the US tax reporting requirements, and this is not an exhaustive list at all. So just some high level things to think about. One is if there is a foreign entity set up, there's definitely US reporting for that. And those forms are for corporations 5471s or 8858s in the case of a disregarded entity, and then an 8865 if the organization is entering into a partnership or joint venture with another organization. One thing that's not on this slide that I wanted to point out is that if you are making payments to non-residents, that's it can happen. It could be for services or for licensing, royalties type things. Those payments are generally subject to reporting and withholding. The form that you're looking for there is Form 1042, and they could also be subject to income or withholding tax. So I wanted to mention that because that's sometimes organizations are doing that without actually having a lot of foreign activity. So be mindful of those forms as well. They're very similar to the 1099s, just they're for payments made to non-residents. Also, Form 990 Schedule F is going to list out the activities outside of the US. Then F bars, the foreign bank account. So sometimes organizations need to set up a bank account in another jurisdiction in order to make the operations more efficient. Also, if you set up an entity, a wholly owned entity in another jurisdiction, their bank account is also subject to reporting for you in the US. Then there's the Form 5713, and that is an international boycott report. Every year they publish the countries that are part of a boycott need to be reported as part of this international boycott report. So if you are doing business with a lot of countries in the Middle East are subject to this reporting, do take a look at that and see if it might be applicable to you. That could apply without having any presence outside of the US, but if you're, providing something to them from the US even. And one of the reasons I like to highlight all of these forms is that in general, a lot of these are subject to a failure to file penalty, regardless of whether there's tax due, and those generally start at $10,000. So you want to be thinking about those and making sure that you're asking your tax advisors, what obligations you might have. All right, then I also like to just mention if the organization is engaging in some foreign investments, which this happens quite often, there may be an issue, a reporting issue with that. And the reason is that we have a regime called the PFIC regime, which is really an organization that has a lot of passive income. So the test to be a PFIC is 75% of gross income is passive, or 50% of net assets are passive. If your organization doesn't have any unrelated business income, then you're not subject to this reporting. But or if the value of that PFIC stock that you own, that you invested in, is less than $25,000 for direct investments or $5,000 for indirect, then there's no reporting. So just something that we need to be mindful of when we're looking at compliance. If you are entering into transactions where you're investing in foreign companies, then let's have a talk about whether that might be subject to the PFIC regime. And then other compliance requirements that you should be thinking about are registration. So just like in the US, if you start doing business in another jurisdiction, you may not have a corporate tax or individual tax obligation, but you may be subject to business registration. So make sure that you're being mindful of that. Also, licenses and permits. So similar comments there. There are also some anti-terrorism things that you need to think about under the U.S. Patriot Act. And there's also Foreign Corrupt Practices Act. So if you're making improper payments to obtain government licenses, registrations, special tax, or custom treatment, which allow your organization to operate in a foreign country, this could be subject to that act as well. Or if you there are other things that could make this apply, like false characterization of improper payments on the company's books and records, things like that. So just make sure that you're engaging with your attorneys and making sure, that the people that are going outside of the US on your behalf are really knowledgeable about these types of things that aren't allowed, to help keep you out of hot water there. And then finally, there is if you do set up an entity in another country, there's also some FinCEN filings. One of them called a BE10 that's actually due in a few days for this year. It's something that happens every 5 years, and that's something that you'd want to be knowledgeable about as well, and make sure that you file that. All right, well, finally, I just wanted to explain a little bit about Eide Bailly and how we are able to assist organizations internationally. Eide Bailey belongs to a network of firms called HLB International, and we are essentially a group of firms that are similar in size and similar in client base that assist each other when we want to go into another country. So if I have an organization that is looking to do something in, let's say, the UK, then I would reach out to my colleagues there within the HLB network, and they would be able to assist my clients. So while I'm knowledgeable at a very high level on some of the taxation aspects in other countries, we really rely on our network to help our clients. So if you ever had a question, needed something related to another jurisdiction, what we need to be thinking about, I'm happy to make those introductions for you. And with that, that is the end of our presentation, and I'm happy to answer any questions. Let's see, I don't see any questions.
All right, if you do have any questions, you can use the Q&A box located on the menu bar, or you can use the chat feature, or you can just contact Shannon directly.
Yes, there is my email and my phone, so happy to have a discussion with you about what you're considering in the international space. And since there are no other questions, we'll give you back 11 minutes of your day.
All right, well, thank you all so much for attending, and thank you to Shannon for presenting, and everyone have a great day.